Okay, let's begin. Welcome, welcome, welcome. My name is Gavin Pannu. This is a live webinar brought to you by Alphachain, based in London. We've currently got a heat wave going on, so temperatures are expected to soar to around 38 to 40 degrees Celsius. So, not looking forward to the heat, but hey, let's crack on. Let's begin the weekly market analysis session. It is Monday, the 18th of July. We have 2 full trading weeks left for the month itself. And let's cover some of the most important elements before we go into the nitty-gritty of markets. So last week, the big data print came in from the US on their inflation report, which was Wednesday. Their headline number came in way above a 40-year high at 9.1% year over year. In fact, if you look at the 3-month over the year figure, that is in double digits. That's above 10%, just below 11%. Okay, so we did see CPI numbers came in and they did overshoot, but there are some indications within the CPI report that it might be exacerbating as well. But only time will tell. The next report will tell us that, right? I'm just going to minimize on it because I just see myself. Okay. Yes. So CPI, the headline data came in at 9.1% year over year from the previous print in May, which was 8.6%. Okay, let's move on. There is now a growing anticipation from short-term interest rate markets that the Fed could raise rates by a whole 100 basis points, so 1 full percentage. Yeah. At the next meeting, which is taking place at the end of this month, 27th of July. So far, we've seen the US and 10-year yield invert again, as it has done multiple times. Is it a recession signal? Well, we've seen it invert far too many times for it to give us that recession signal. I think it's market known about that. It's a very common sort of, the 2s and 10s inversion is well known. But it does give us some form of signal. Yeah, there is that anticipation between the difference in the bonds that, hey, markets are not heading in the right direction, right? There's fear in the market. Okay, so moving on. The major US stock averages were last week initially quite weak, right? But they actually recovered quite well. Okay, they rebounded quite well towards the end of the week. I think one of the key highlights from last week would have been the euro dollar. The euro dollar had hit parity for the first time. Well, it's not the first time, but it's hit for the first time in multiple years. I think the last time it took place was somewhere between 99 through to 2002, where we were below parity. Okay, so we saw the euro dollar hit parity. Now, moving on, what will be key for the week ahead? There will be sort of 2 areas that I will be focused on. Well, let's say 3 areas. Okay, the first and most important for me would be the upcoming ECB meeting. Okay, so we have the upcoming ECB rate decision, as well as a press conference. So we'll hear from Christine Lagarde, the chairman of the ECB. And already markets are pricing in 25 basis points rate rise. Okay. The second most important element to remember for the week ahead would be earnings. Now, with earnings, that's an indication of all these macro data that we're reviewing, we talk about on an ongoing basis, how much of that is impacting corporations, and then it spirals into the consumers, how much of that will impact consumers. So an example of that will be if we start to see that earning reports come in worse than expected, or they give us indication that they're going to make drastic changes in the way they run their operations, whether it's reducing jobs or it's reducing sort of labor force is probably generally sort of what I've been focused on in the last few months, as we've seen rhetoric from a number of corporations discussing reducing their labor force. So that's what we sort of want to see from the earning reports, is how much of the current macro environment is being impacted by corporations. What do they see going forward? What do they forecast going forward? And what's coming into effect anytime soon. So, and the final point will be, is the final element for the week ahead will be, is the flash PMI data. Okay, so the flash PMI data is going to be an important one as well, right? So who do we have earnings from? Well, it's in full swing. Okay, so far from the previous week, it started off last week, Thursday, with the financials, right? So within the financial sector, we had both JP Morgan and Morgan Stanley both came in with disappointing results, whereas Citigroup was positive. Okay. Now that we're getting into the full swing of earnings, expect earnings from the Bank of America, IBM, Goldman Sachs, Johnson & Johnson, Netflix, Tesla, Twitter, all in the upcoming week. Right, let's switch over and let's have a look at some of the markets as well, right? So let me just ensure that I can see, right, thank you. Let's just minimize that. Okay. Now, where should we focus on? What should we look at first, right? So I think before heading into equities, let's come back over and let's look at sort of the currency markets. The currency did come into focus last week, obviously with, as I mentioned, euro-dollar parity, right? So it was a very volatile week session. Last week, we initially started off quite bearish, and then a lot of optimism came in at the end of the week. And what we did see is that because of the weakness in the beginning of the week, it was generally led by the dollar strengthening. Okay, we saw a lot of dollar
rises to a 1 week high.
We saw the dollar strengthen quite significantly over that period of time, as markets begin to forecast higher rates by the Fed members, right? In addition to that, you had the risk of a recession, also the risk of a recession as well. Okay, so as inflation continues to surprise to the upside, so we saw a much larger sort of inflation number. Central banks are now going to begin to tighten even more aggressively. And something that gave us an inclination of that taking place is the Bank of Canada. So last week, the Bank of Canada, we expected to raise rates by 50 basis points, came in actually raised rates by 100 basis points. This is the first time we're seeing a G7 country going on to raise rates at such a dramatic increase, right? 1 full percentage point was raised. So that was a very surprise move by the Bank of Canada, right? But, markets are now also at the same time looking at the landscape ahead. They're forward looking, right? We're looking sort of not just what's happening right now, we're looking at what's taking place in 3, 6, 9 months from now, right? And as we see that there is this shift where we've got this double sort of dynamic taking place, right? Think of a barbell. You've got a barbell. On one side, you've got this overshooting inflation. You've got central bankers doing whatever they can to tame inflation, right? But then on the other side, you're starting to see that the macroeconomics is beginning to weaken, right? So GDP is beginning to slow down. We know that at the same time, China's going into these zero COVID policies. So these shutdowns and lockdowns and restrictions taking place there is also going to hinder the global sort of supply chain as well, which could cause a potential recession. And that's what we're sort of trying to manage. And the expectation of the recession is rising. And therefore, that's why markets are beginning to already forecast that there could be rate cuts 6-9 months from now. And that is because we could be in that recessionary period. Okay, so that's something to be just mindful of. But anyway, before we'll go into a deep dive on the euro dollar, and I'll go to the chart. Let me just have a quick sort of. I'll bring in sort of the US equities, and I'll just hit the refresh there so you can see that quite clearly. So starting at the beginning of the week itself, you can see a lot of weakness hitting these lows, right? So we saw 3 days of selling pressure coming into place, pre-inflation results, right? Pre-inflation results, selling pressure coming through, anticipation of a high inflation number, came in much greater, a bit more of a selling whipsaw to the downside. And thereafter, market started cooling off, and we started to see some positive earning numbers, and a bit of optimism stepped in, and we saw markets recover. Okay, so overall, we're seeing sort of that recovery continue today, as there's been not much news over the weekend anyway. So stocks did finish sharply higher on the Friday session, so snapping this 5-day losing streak. Thanks to that, we had a strong earning results from Citigroup, for example. But at the same time, there was that stronger than expected retail sales data come out from the US, right? And the expectation that this inflation number, that is the highest peak in what we may see, and it may cool off as some of the readings within the report itself came in slightly, gave us a little bit of hope, should we say? So, and as I mentioned, Citigroup surging 13% as it was reported the best second quarter results of any big bank so far, right? There were comments now. Now, let's indicate some of these comments, right? From the president of Atlanta Federal Reserve, he indicated that he would not support a potential 100 basis point rate rise. So we saw inflation come in much greater, that then the markets begin to forecast that, hang on, okay, let's just see, let alone 50 basis point rate hike. Now, 75 basis point rate hike is on the table and has the highest probability of occurring. But then what about 100 basis point? Is there a chance of that following the lead from Bank of Canada, right? So that's what the market's forecasted. We did see that the president of Atlanta Federal Reserve indicate that's not likely to occur, okay? And that's giving, some little bit of hope and give a bit of an equity push to the upside based on there won't be such a drastic large rate rise, right? Okay. But overall, Friday's rally still was not enough to overcome 3 days of selling pressure from earlier on in the week. So, overall, we've seen we've got to really push through those highs of 3,920 for the S&P 500, and for the Nasdaq, you're looking at 12,181 level. But we are fast approaching those levels. Okay, we are fast approaching those levels. And as I've already mentioned, earnings is what could set the tone for the week ahead. Okay, we've got a diverse group of earning reports being released this week, right? So as I mentioned, from Bank of America to Johnson & Johnson, a consumer sort of staple, right? And then you have Tesla, and then Netflix as well, and we know how much selling pressure had taken place in Netflix anyway in the last few months. So investors are going to be waiting to hear updates on the company's outlook for not just right now, but the year ahead, the rest of the year, right? So H2, and then looking into the new year. And what they're looking for is these clues on how corporate America believes the economy is faring. That's the sort of the key point there. Yeah. Okay, switching it back over. As I mentioned, euro dollar. Sorry, fighting a cold at the same time, guys, in this heat wave. Right. So I might dial it back to the higher time frame. We'll go to the daily time frame. We'll just focus on the dollar index itself. So the US dollar was the king of currencies, right? They say cash is king. Well, the dollar is king, it seems, in this case, for yet another week. It just continues to march higher against most of its counterparts. And the most anticipated point happened last week, where we saw euro dollar for the first time in many, many years hit the parity level, right? So 1-on-1. Yeah. So we are literally well, you can see Americans coming into Europe for the summer are certainly going to be happy with where the rates are, exchange rates are. So yes, there's the dynamics that we're seeing now. If we go into the dynamics that we're seeing is, if you look at the US economy, yes, they've got very high inflation, but that inflation is almost equally matched if you look at the European inflation of each region. And within the regions, or should we say, within the Eurobloc countries, the main countries you focus on, whether you take the 19 or the 27, right? You can see the inflation where they are, and the average is somewhere around 8.5% or just shy of 8.5%. Okay, but US inflation is coming at 9.1, slightly higher. But the Federal Reserve have stepped in multiple times and maybe ahead of the curve in comparison to where the European Central Bank is. They have not risen or raised, shall I say, their rates at any point so far, where most central banks already have, not just once, but multiple times. The Bank of England has done it back to back 5 times in a row. So the ECB are behind the curve when it comes to managing market expectations in regards to taming inflation. So that's one of the key factors that's driving a lot of euro weakness, and then of course dollar strength, right? The other side to it is, if you're an investor and if you're a professional investor, and most of you are that join these sessions anyway. Now, what you would be thinking about is, okay, if I've allocated within my portfolio a certain amount into fixed income, I want to generate the highest yield, right? Where is the highest yield that I can achieve without the risk of default? It would be if you buy, a US 10-year treasury, right? If you look at a US 10-year T-note, they're sort of hitting sort of 3% levels, right? So you can achieve 3% on your bonds that you purchase from the US, right? Why would you want to take risk anywhere else, right? If you're achieving already 3%. So yeah, that's something to sort of consider, especially from a fixed income asset allocation, right? And that's what's taking place. And then we're just seeing a lot of strength, not just coming, now the yields might be rising, but at the same time, we're now seeing bonds being bought up at the same time. So a lot of foreign investors are beginning to buy the bond because the chance of the US going to default is, pretty slim, shall we say. They've got a very good credit rating, but in the Euro region, we know that, for example, there is some countries that are having debt to GDP ratios. So at the beginning of last week, we heard about Mario Draghi, right? He wanted to resign, but some of the top officials said not to resign, and they've got a bit of a concern where they may default. So there's a lot of there's a credit crisis that's taking place in the Euro region, especially for some of the southern-based countries, based on their debt to GDP ratios, that also is hindering them to, make the moves required to be able to tame inflation. Now, we do know that the ECB are applying a new tool. Now, we don't know much about it, anti-fragmentation tool, but we'll see over time if that has any influence. But generally, like they say, don't fight the Fed, don't fight central banks. If central banks do put in this new tool, that could certainly help stimulate and give a little bit more optimism in across market participants. Yeah, and then we're not even brought into this the fact that what's taking place with Russia invading Ukraine as well, right? So that political concern is still ongoing at this moment. So now that's led to this significant sell-off, and euro dollar reaching sort of this long-term. Look at the downtrend that we're in, right? So and the downtrend just continues all the way through, lower lows, lower highs, a bit of consolidation in the midpoint over there, somewhere around sort of December, Jan, and then come into sort of Feb, March, we start to see the next down leg continue, right? The question is, where do we go from here? Clearly, the parity level is a very strong psychological number, figure. Therefore, we're seeing a bit of a rebound off that level, okay? A bit of a rebound off that level. Looking at the pound. So it was another terrible week, should we say, another terrible week for the pound, seeing continued weakness in the pound. So the pound is underperforming against most currencies, to be fair, and it's failing to find any level of support at this moment. And that is even though we had strong UK data. We had certain UK data coming in positive, but there were other elements that came in negative as well. Okay, so retail sales didn't come in so well for the UK, where it did come in very as a positive number for the US. So there is a lot of concern that the UK economy is also facing a lot of struggles. There's that the Brexit is still ongoing in the background. Then you've got the political issue of Boris Johnson resigning. We're now looking for the next PM. It's going down from 5 MPs, Conservative MPs, who yesterday had a debate at 7 PM on ITV. And we're looking at another debate to take place tomorrow. And then we'll find out who will be the final two. out of the final two, it's more likely that it's going to be Rishi Sunak, who's the ex-chancellor, the finance minister, and then we have Liz Truss as well. She's she works on the foreign side of the foreign secretary, right? Now it will come down to maybe them two. It does depend on sort of where the vote goes. Towards the end of the week, we'll find out. Then Thursday, MPs go into this summer recess. So we're going to hear, that means that generally what they do is, it's not summer holidays for them, for these UK politicians. What it is just a way for them to outline time for their constituency. So where they've been voted to become an MP for in their local region, they can go back to their offices there and deal with sort of local agendas, basically, right? So they'll be doing that for some time, but at the same time, we're going to hear from the final two. That'll be a time for them to campaign. Okay, they'll be campaigning through till we'll find out who will be stepping in on the 5th of September. Okay, but that's still a lot of uncertainty. What market participants want. We'll find out more. I'll probably do a bit more of a deep dive into UK politics sometime soon. But again, that's just more uncertainty for the pound. Not only do you have macro data coming in worse than sort of expected, we know that the Bank of England have not raised rates dramatically enough as the market have wanted them to do, so that they could tame inflation, even though inflation coming in as higher numbers. And it's expected over the next 2 to 3 months, we could see double-digit figures. And then that's not even bringing into how consumers are feeling around the price of energy, price of petrol and energy. The energy is likely to soar again. So yes, there is a lot of cost of living crisis, whilst there's this other macroeconomic concerns that we've just spoke about. Yeah. So looking at commodity currencies, now the commodity sell-off and the strengthening of the dollar is not helping commodity-based currencies. So what does that include? Well, Canadian dollar, Aussie, and Kiwi, and the Norwegian krona. Not many of our traders trade the Norwegian krona, right? They all fell somewhere between 0.5, maybe up to 1% against the greenback. So just be wary that when you're looking at commodity-based currencies, you've got to focus in the commodity sector and how is that market facing. Looking through to other markets, other FX markets, where you have, for example, Swiss franc, Mexican peso, some emerging markets, they were broadly unchanged. The yen, we did see it was another very poor showing, a poor week for the yen. I might touch on that in a little while, but what I want to do is maybe go into the oil markets a little bit. Okay, so we'll come back over to the oil markets, just be mindful of the time. Okay, so last week, we saw for the first time the oil market sold off below this support level of 95 handle, testing the lows of 90, should we say 91 or 90.78, So it was another poor week, a poor showing for the oil market. And there are two elements. The first is the US released some of their SBR reserves. Okay, so they're releasing some of their oil reserves into the market, trying to hope to sort of flood the market with a lot of oil, therefore price goes down, right? So if there's more supply, that's going to have a knock-on impact on the price. But at the same time, we are seeing that those SPR sort of levels that are being put into back into the market, there is still, supply still remains quite tight. Supply does still remain quite tight. In the short term, oil should remain in this sort of, in a balance, right? But what did push it a little bit lower is the fact that news came out last week in regards to China and certain regions in China. We're seeing, again, continue with the zero COVID policies. We heard some COVID announcements or COVID cases coming through, and therefore there were certain regions that were closed down. So, for example, there were some casinos based in Macau that were shut down, and that's caused a lot of these casino shares to fall substantially as well. So, yes, again, rhetoric around China and their lockdowns is certainly having a knock-on impact in the oil markets, in addition to what we're seeing with the US SPR reserves being pumped into the market, right? Now, to sort of touch on anything else within the oil markets, let me just have a quick look here. Okay, so now that just covers what's been imminent in regards to the oil space itself. Going into the specifics. Now, we know that that America are looking to set up their presence a little bit more. They want to assert their presence a little bit more, especially in the Middle East, right? So they've spent some time in Israel. We know that they've been in the Middle East for some time, right? So so President Biden, became the first US leader to actually fly directly from Tel Aviv to Saudi Arabia. Okay, and on their itinerary, it's somewhat of a resettling of relationships, as we've seen where energy prices are now. So there's going to be this discussion between Saudi leaders and US administration, right? Joe Biden is going to go over with his administration. They're going to have these detailed discussions, right? These detailed discussions with MBS and his co, right? To really sort of align maybe if there's a allegiance that they can form in regards to the energy prices and overall energy security, right? So that's something that to sort of think about and sort of hear about, wait for more information to come through, so that we learn if there is going to be any positive outlook from there. A key question, obviously, on Joe Biden's mind is, can he convince the Saudis to pump more oil so therefore the price comes lower, right? I mean, that's sort of the key objective there, right? But anyway, overall, the world has not witnessed this in many, many years, where we've seen such major energy crises occurring globally, right? It was the oil embargo that took place in the 1970s, and that led to sort of the inflation concern then as well. So we're seeing a similar situation, but this is more of a global situation here. So just be mindful of that, yeah. And there could be more to see, more worsening of conditions to see in the future, right? So that's in regards to the oil markets. Having a quick look at where gold is. Gold, of course, we've seen it fall from some of those key highs here. So this old analysis there, but I need to update this at some point this morning. But anyway, we've seen oil tread down all the way back to the 1700 figure. We're back down to 1700. It held that psychological number, and thereafter it's pushing a little bit higher. We're back up to close enough to 1720. We're at exactly 1718.97. Okay. So we're just seeing precious metals overall had a fourth negative week in a row. It's finding no bounces at this moment, right? It just continues to break low and break lower and break lower, right? And reports are now showing that retail trader positioning index is finally moving away from extremely bullish levels, yeah? Which means that long capitulation is finally starting potentially. But again, a very key level of support will be for gold is somewhere around the 1680 support level. Okay, so just be mindful of that, the 1680 support level, and if we're back above into the 1730s, we could see a bit more of a upside move. So just be mindful sort of the key levels back down to these points over here. But again, we're not finding support. We've pretty much wiped out all the sort of this part here, this move here was the start of the Russian sort of invasion of Ukraine. Okay, so where oil had been starting at the beginning of this year through till sort of the peak and the heightened of tension between Russia and Ukraine. Okay, now those sanctions came into place with a global sort of all major economies began to sort of fight against Russia at the same time. Since then, we've just, pretty much given up all those gains and back down to sort of these new lows over here. So we're certainly in a bear market when it comes to the gold space. The question is this, right? When does gold outperform, right? Generally, it's linked to inflation, which we've not seen so far. That's purely because markets are pricing and that inflation is there for the short term. I don't want to use the word transitory, but it seems that market participants don't believe it's as transitory as central bankers did. But, they do feel that central banks will pivot within a year or two within a year, like I said, within a year or two, they will pivot back to, where they begin to loosen their stance, right? Now, if inflation's here and is here for a much longer period, then we could see another sort of move to the upside in the price of gold. But just be mindful of sort of the inflation concern there. Now, the risk of recession, even though it continues to grow, even though we see the 2s and 10s continue to invert, but that's not enough. That's not enough. We've seen that before. It's happened many times before, especially the 2s and 10s inversion. But there needs to be more. There needs to be more. And when we do see that occurring, that could be from very negative earning reports, as mentioned earlier. So just be mindful of the earning reports. If we start to see them, even though the central banks are raising rates and they begin to raise rates far more than market anticipation, again, that's going to lead into a hard landing, which could not have a knock-on impact into getting into a recession earlier, rather than a soft landing where they, we teethe the line of being in managing the inflation concern, but at the same time not going into a recession, right? Okay. So that covers gold as well. And finally, so you can see sort of equity markets really pushing start of the trading day. Another market to sort of look into. Now we've seen some upside moves in Ethereum and in Bitcoin. Bitcoin back above the 22,000 mark, so that's good to see. Ethereum back up 1454 at this current moment. So bit of a bull run taking place in the crypto space. As I mentioned, over the last few weeks, we had seen some consolidation taking place in the crypto asset, in these crypto assets. And the key point being is whatever negative news we're hearing, it's not having another move lower in the price of these crypto assets, right? So we're seeing markets are still managing to stay above in these regions, even though there's negative news coming through. So therefore, it seems like there could be a bounce in market price, right? But don't be so eager to get into the markets just on that one bounce here. You need a confirmed breakout, right? Confirmed breakout, then you need a trend to begin, right? So wait for the next pullback, wait for the pullback to occur, and then look to sort of buy in at the dips there. Be patient, be patient. The trend has not begun yet, but certainly we're seeing some optimism step in. For short-term traders, you may look to sort of, look to take the breakouts, but ensure that you are carrying out in-trade management of your trades as well. Yeah. Okay, so that's a quick wrap of the markets where we are. As I mentioned, for the week ahead, we have the ECB rate decision. We have some other macroeconomic data that you could focus on as well, as I've mentioned. But the most important will is microeconomics, right? Looking at sort of corporations and their views of how the economy is faring. That will be where the focus is. Okay, thank you for joining in the session. Hopefully you found this insightful. If you have questions, if you have requests to cover for upcoming sessions, I'll be happy to do so. And yeah, feel free to like and subscribe to our YouTube channel. For our private members, obviously, you know where to reach me. Send me a direct message and I'll look forward to speaking to you soon. Have a great weekend. Take care. Bye-bye.